When it comes to futures trading, one concept stands above the rest: risk management. Risk management is the process of identifying, analyzing, and mitigating the financial risks involved in trading. It's not about avoiding risk completely. That's impossible in trading. It's about making sure a single trade or even a bad day doesn't take you out of trading completely. My opinion is, in futures trading, this is even more critical than in something like equities. Why? Because of leverage. With futures, you can control large amounts of capital with a relatively small margin deposit. That increased leverage can magnify both your profits and your losses. In fact, one of the biggest differences with futures is the potential for unlimited losses. There's no built-in safety net if the market moves sharply against you. That's why having a risk plan isn't optional, it's essential. So, what does smart risk management look like? First, understanding your margin requirements. Initial and maintenance margins tell you how much you need to hold a position and how much cushion you have before facing a margin call. Second, use stop loss orders. These are intended to be your safety brakes. They take emotion out of the decision making and cap your downside if the market turns against you. If you do not use stop orders, you should certainly have a level where you would consider the trade invalidated and no longer worth holding. Keep in mind, stop losses are not guaranteed and may not execute. Third, you may consider setting daily loss limits, a hard stop for your overall trading day. Daily loss limits can be built into the account with your broker. Once you hit that number, the system should lock your trading account. There's of course technology behind this, so it is not guaranteed. Always keep an eye on your positions. Futures markets will be here tomorrow, but your capital won't be if you overtrade. Discipline is the fourth and often the hardest part. It's easy to make exceptions, just this once. But over time, those exceptions add up. Stick to your rules and give yourself a long enough runway to learn, grow, and potentially succeed. Another important piece, position sizing. Don't risk more than a small percentage of your account on a single trade. That way, one bad trade won't undo weeks or even months of progress. And lastly, use the tools your broker offers. Platforms like EdgeProX and other offer features like trade journaling, alerts, and risk dashboards to help you stay aware and in control. Futures trading offers opportunity, but only if you can manage the risks that come with it. The best traders don't avoid losses, they limit them. They learn from them, and they make sure they live to trade another day. Thanks for watching this Edge Short. If you have any questions about this strategy or anything regarding futures trading, feel free to contact your broker here at EdgeClear. Happy trading.